Hey folks, Todd Martin here with Realty, your local real estate broker here in Louisville, Kentucky. Appreciate y'all stopping by today. Today I've got Brian Schutte with Ruoff Mortgage here with me, and we've gotten a lot of questions here lately with regards, our clients are asking, regarding credit, COVID-19, kind of what's going on, what do we see, do we have a crystal ball, and is now a good time to buy a house? So really what I want to do is, again, introduce Brian with Ruoff Mortgage here. Brian and I, we've known each other, how long? Maybe?
Right, 10 or 12 years probably, yeah.
Yeah. So
back to the Century 21 days.
Don't say that now. But yeah, so we've known each other for quite a while, and had the ups and downs and seen quite a bit of the market swing. And Brian, really what I'm trying to find out is, since today's change and with COVID-19 and all these things happening, with people qualifying for a loan, what are some of the biggest obstacles that you're seeing with regards to people actually qualifying and being able to purchase a home?
The two big kickers are changes within the loan programs that are happening daily. So all across the market, different lenders are adding overlays or new requirements on loan products, be that debt to income ratio adjustments or credit score minimums. So probably 3 weeks ago, there was a buzz around town that everybody was taking their government minimums up to 660, in some places 680 credit score minimums. We did jump up temporarily to 660, and a lot of that was because of lack of guidance from the government on how this forbearance piece and some of the changes to Fannie Mae and Freddie Mac that were going to happen as a precautionary measure and in other measures to help consumers, to make sure they're protected, to make sure mortgage investors are protected. So they started putting forth some added layers of requirements on some programs, again, raising credit score minimums. Prior to all this, we could do an FHA loan down to a 580 credit score if we had an automated approval through Fannie Mae's DU system.
Okay.
Then it sharply jumped.
DU stands for
Desktop Underwriter. It is it's kind of one of the universal systems that loan originators for the secondary market use. Mm-hmm. So their Fannie Mae has their version, and Freddie Mac has their version of that automated system. So in most cases, I would say a heavy percentage of loans are an automated approval in that DU or LPA system, which LPA is Freddie Mac's version of that. So we run the loan approval through that. So we pull credit, run the approval through that based on the income that we've verified, and they determine all the risk factors electronically, and it issues an approval based on that. So if we had an approval on the DU findings down to a 580 for an FHA loan, we could do that. Then again, sharply, right after with the COVID-19, then some investors and some overlays came out raising that credit score minimum. You could talk to 4 different lenders around town. Some stayed at a regular, some jumped to 660, some jumped to 680, and all kinds of variances. We sharply went to 660. And then within 2 week span after we started to get some clarity in the market with risk tolerance, we backed that back down to 620 for all of our government products. So that being RHS, VA, and FHA. So we can go at a 620 with that approval.
Okay. Well,
actually, and on top of the DU approval, there is what they call manual underwrite guidelines. Mm-hmm. So FHA and VA and RHS have all issued their set of manual underwrite, meaning I don't have an approval in the automated system, but my debt to income ratios are in line with that product. My credit history is pretty clean for the last 12 months, and I can prove 12 months of rental history. then you can fall in a category of what they call a manual underwrite, where the underwriter physically goes through all of FHA, VA, or RHS's guidelines to make sure you're in compliance with those.
Okay. And that kind of leads me into really kind of the second question, and you've pretty much answered that already, is that it looked like, several weeks ago when all this started, that the market came in and did a knee-jerk reaction with raising the rates, and the lenders and the investors wanting to be protected, and now it does seem to be settling down a bit, getting back to some of the norms, and obviously you're seeing these changes happen as well. Things
Yes.
come settling back down.
It is settling back down. So if you look back to those of us that were around in 2008,
Mm-hmm.
When the market fell apart, the easiest way for the mortgage market, that is, to try to get a grip back on everything, was to raise the standards sharply, to kind of slow the barrier of entry, per se, meaning making it a little bit tougher for borrowers with high debt to income ratios or lower to moderate credit scores. So the easiest way for them to control the flow of mortgages coming in, being truly the quote cream of the crop,
Mm-hmm.
was to tighten those standards. So I think, and this is my opinion, that what has recently gone on is some reflection back to those days when we started getting uncertainty about the government talking about the forbearance program. Folks, we're at 20 million unemployed projected for Friday. So all of that made the investors in the mortgage market say, put a screeching halt on this a little bit, slow this down until we figure it out.
Sure.
So I think everybody came out with knee-jerk reactions to strip some programs away, tightening of credit requirements, tightening of other pieces of the approval process. And we're slowly, especially as we're moving towards opening back up state by state, I think there's kind of coinciding with the fact that people are going back to work,
Mm-hmm.
starting to go back to work. We're lightening up on that. And with that, we're starting to see some requirements ease just a little bit in terms of like lowering that credit score minimum back down to a 620 versus a 640 or 660.
Okay. So, I guess what you're telling me is that, the COVID-19 pandemic, really what it did is it kind of increased the credit requirements in the beginning, and now it's decreasing back down to some normalcy.
Correct. Because, I've probably already said this word 4 or 5 times in our conversation, the word forbearance.
Mm-hmm.
That is the term that is the most uncertain in the mortgage market. So in theory, your folks that are 700 credit score, 720 upper credit scores, lower debt to income ratio, on the job right now, full employment, regular pay. Those are your folks statistically, in theory, however you want to state that, are less likely to call and request a forbearance on their mortgage or need help or assistance, because those are the folks that are working. They typically had some skin in the game. They put some money down on the home, and they have a higher credit score, thus a stronger, quote, credit history. So those folks are, in theory, less likely to be the ones that would need forbearance or request forbearance in the near future.
Mm-hmm.
Or eliminating some of that risk to a loan originating company or a loan servicer. So that was the easiest way to tighten the screws on that a little bit, is make the barrier to entry the ones that we know or we feel statistically have a less chance of requesting to go into forbearance. So as we're seeing people go back to work, hopefully in the next coming weeks, then we'll be able to loosen that back closer to where we were, because folks hopefully will start to recover financially, and the threat of borrowers requesting or going to forbearance will be will ease a little bit. I think the last statistic I saw that I believe a little over a million homeowners had requested forbearance on their homes, and with the anticipation of that to double to 2 million. So as a mortgage originating company, a mortgage servicer, those are all risks to the mortgage market.
Right. And let me make a little a note here on forbearance. Again, that's the word that's being thrown around right now during this situation. And I've gone into some detail in some other videos. I'll make sure that we'll have them with descriptions and links and timestamps on this once we get it done. But I would encourage anybody that's questioning whether or not to go into forbearance to check those out. And then I will also be doing a much more detailed and in-dive depth into forbearance. And again, probably bringing Brian back on to discuss how this can really affect your loan, towards the negative side if you're not careful, if you don't understand and know what you're doing and really, really research that. So just a word of caution, be careful if you're thinking about forbearance, because it can have some implications to you in the short term and in the long term, but we'll get into that a little bit later. And then one thing, and it sounds to me, Brian, and I'm not sure, I know you talked about some of the fears with these lenders and with these fears with actually, lending money. If you had to guess, what would you say is the biggest fear right now with these lenders and investors, giving money to buyers?
One of the biggest fears is job stability, income stability.
Sure.
So Fannie and Freddie have recently tightened up some of the requirements to proving that the borrower is working at the normal rate of pay, normally working at the normal hours as they previously were, and some of that then. So Fannie and Freddie and the government, FHA, HUD, USDA, they will come out and give their quote guidance or guidelines for programs. And it's kind of like the federal government. We can have a federal law, but then a state or local entity can come in and have their laws that are slightly greater than that, right? So your neighborhood association can say, it's not a federal law that I have to have a certain type of fence in my yard, but my neighborhood association has a right to come in and enhance that law or add more to the law. They just can't break the federal law, right? So kind of the same thing when you're looking at loan servicers, loan investors, loan originators. They come in and they have Fannie and Freddie's guidance, HUD's guidance, and USDA's guidance for their programs. But then investors can come in and add their own overlays, their own extra layers of protection. So while we're being told by Fannie, Freddie, FHA, USDA, here are the requirements in terms of credit, employment, we can also come in as servicers and lenders and add additional layers in there to protect ourselves or the mortgage market for those. So there's become a little more follow-up, a little more last-minute follow-up on employment, to make sure that the borrower is still actively employed, and they're still employed at a rate, numbers of hours pay that is in line with what we use to qualify them for the mortgage. So if, wouldn't do us much good if we're approving you for a 40-hour job at $20 an hour, and then right prior to closing, we find out everybody in the plant's been cut back to 20 hours, and we don't know how long that's going to last. So in what jeopardy is that putting the borrower and entering into that loan at the time of closing the loan, knowing that you're getting cut to 20, so your income's getting cut in half. So that's one of the toughest pieces. We've had, a number of folks day before, 2 days before, that have been laid off, furloughed, gone into a position where income is not there. So we've had to ultimately wait that out until they're returned back to work in those cases.
Sure. And I think that's the big unknown for a lot of people that are out there. So hopefully, as things start to come back, people will be much more incline, and I think the economy, hopefully the economy, we'll see a pretty steady recovery. You know, I'm figuring there's going to be two things that are going to happen in the housing market, Brian. One is people are going to go, you know, I like my house, but man, I can't live with this kitchen anymore, and I need to redo. So, you know, we're probably looking at cash out refis so people can get that kitchen because they like the location, or they're going to be in the house and they're going to say, you know what, I'm tired of this house and I'm ready to move. I'm ready to downsize. I'm ready to upsize. So I really think
ironic you just mentioned, sorry, I didn't mean to cut you off, the cash out refi portion.
Yeah.
So that's one of the recent tightenings.
Okay.
In the market. That's, I mean, when I say recent, I mean within the last 2 days. There are some brokers, mortgage companies that won't even do cash out refinances at the moment. There are others that have restricted the loan to value on cash out refis.
I gotcha.
Because again, not that this is what folks are doing, but in theory, I could come to you and say, listen, I'm going to cash out, take 20 grand, cash out of my house, and then knowingly turn around right after that and put my loan into forbearance. So if I did that, I just got 20 grand knowing that I'm not going to perform on this mortgage, and then put my loan into forbearance. So that's putting the entire market in jeopardy.
Yeah, we don't want to get back to 2008, 2009, you know, standards. Just being very, very cautious there. Okay, so there's a lot of we've touched on a lot of things, and I know one thing that I keep getting all the time, and this is especially with first-time home buyers and with the way that the things are being tightened up now, and people are looking at their credit. And you know, I mean, Brian, when you and I started doing this years and years ago, you know, you had to talk to a loan officer or a banker to get your credit pulled. And right now, everybody can get their credit score online, pretty much for the most part through their credit card companies. And, you know, I get a lot of questions that, you know, people say, well, the loan officer says that my credit is here. Bless you. The loan officer says my credit is here, but when I pull it, it's saying my credit is here. Why is there a difference between when you pull it and when they look at their score online through their free account with their credit card company?
So Credit Karma, your Chase account, all those ones that give you the quote free score, while they are a valuable tool because you can check for inaccuracies, you can check for account reporting of your credit accounts, credit cards, mortgage cards, whatever. It's a great tool for that. And it's also a great tool to watch the trajectory of your credit score, whether it be going up, down, remaining the same. But the caution that we always give is most of those are free services. Most of those are, but they're also consumer-based credit. So when I go apply for a credit card or I go to purchase an automobile, that they pull a consumer credit report. That report is using a scoring model, FICO version or different model, slightly different than what you're using for a mortgage credit pull. So to my third grade understanding of this is when I get a consumer report, it's comparing my score, my history, my profile to consumers, everybody that has a consumer account across America. So it's putting me in a 680 range, percentile-ish, you know, range of compared to, it's not a percentile, but a range compared to every other American that has consumer debt. When I go to apply for a mortgage, so every mortgage company is registered as a financial institution or mortgage company whenever you're pulling a credit. So if you look on your credit report, they're actually coded differently. So if an automobile finance company pulled my credit, there is a coding after their credit inquiry that is different than a mortgage bank pulling your credit. So, but when we're pulling it through the models that we're using for the purpose of mortgages, and each of the three bureaus uses a different version of the FICO and credit reporting. But that is comparing my profile to other homeowners in America. So while I have a 680 consumer report, comparatively speaking to all of America, I may have a 620 mortgage score in comparing my profile to mortgage holders in America. So the best thing I tell folks with your Credit Karma or your Chase Bank or whatever you go through that pulls up your, because I know I have a Chase credit card and I can put the button in, it'll tell me what my credit score is. Well, the best thing I can tell you on those is use those to understand the direction of your credit. So if you're in a position that you're wanting to improve your credit or monitor your credit to try to get some things to fall off, those are awesome, amazing tools. But know if I started a month ago with 620 and I've been watching my Credit Karma jump up and now I'm at 680, it stands to reason that your mortgage score has also increased. Now,
Right.
It's probably not increased to match that model exactly, but you at least know the trajectory of your score for a purpose of a mortgage. So the best thing you could ever do when you're entering into the thought process of purchasing a home, and a lot of people walk in saying, I'll never be able to buy a home. Well, you can't get anywhere that you never started, right? So even if it's a year, 2 years down the road, if I don't start today, I can't ultimately get there. So even if I think it's a pipe dream, that it'll never happen, I've had bad stuff in the past, and you know, my saying to that is, you know, bad things happen to good people. What happened, happened. You can't dwell on, we can't go back. But what we can do is establish a baseline today. And you look at your credit and put together a plan to move forward to, you know, being in a position to you can own a home. At that point, you come in, a mortgage professional pulls your credit and says, hey, you're a 595. And you said, well, I just pulled my Credit Karma and it said I'm a 630. Well, okay. So moving forward, you watch your Credit Karma, right? As it moves from 630 to 650 to 670 to 680, your mortgage score is probably not the 590, not 595, not 590 anymore. You're moving up to 620, 630, and probably getting close to being in the range where necessary to purchase a home. So use those tools, because again, great tools to monitor what's going on with your credit in terms of dings to your credit or accounts that are reported late or new accounts open. Those great ways to track all that, but understand the scale is relative but not exact.
Sure. And that's an excellent point, Brian. You make an excellent point. And I tell all my clients, like, look, it doesn't hurt to talk to a mortgage professional, and you're going to have one of three things at the end of the conversation. The first thing is going to say, hey, everything looks great. You're ready to go shop for a home. The second one is going to be, you know, you're doing okay, but there's a couple things we need to change to boost you so you can be ready to shop for a home. And then the third thing is, you know, you've got some work to do. But like you said, at least you put together a plan to do that. And then as soon as they're ready, they can lock in the best rate for themselves.
Exactly. And two of yours over the last couple of days are perfect examples. Two potential clients. One is a simple fix of a credit card, reducing the debt on a credit card, having that rescored or letting the natural process take place, whichever he prefers. That's going to jump him into a range that qualifies for a mortgage on a simple tweak to the credit. And that was probably just completely based on the fact that no one had educated him on this particular concept about keeping the credit card minimums or keeping your balance under, you know, they say under 50%, under 35%, under 15%. Those are all kind of magic marks. When you start, if I have a $1,000 credit card and I have a $950 balance, I'm losing points on my credit. I'm not gaining anything because I'm nearly 100% utilized on that particular debt. So first major marker that I always try to have people attack, because this seems to be the most reasonable one for them to do quickly, would be to get that under 50% to where we start getting back to the good. Then the next marker is around 30, 35%, and then ultimately try to get it as close to zero or under 10-15% as you can. Most folks in the mortgage world today all have access to tools, simulators, scenario builders that can assist the borrower to make those quick jumps. And one of your clients, the conversation happened this morning, and it was literally a 5-minute run through scenario. Hey, here you go. You pay this down to here. Your score is going to jump up X points. And those X number of points is going to put him in the range ready to go. So if he has access to the capital to do that, we'll make that happen quickly. We'll get that score corrected as quickly as possible and be out shopping real soon.
Sure. And, and Brian, we threw a ton of information at people today. A lot to take in, a lot to dissolve into our gray matter, so to speak. But here's the thing, again, you have to start the journey with beginning and an end in mind. So if you're looking to, purchase a home and you have some questions, by all means, talk to the professionals, ask questions. We don't bite. We're happy to help. So Brian, how can people get a hold of you? What's the best way for somebody to reach out to you if they've got some questions?
The best is my cell phone. It's 502-262-9596. I believe you have it on your site. And call, leave a message. I'm open to text messages. That's a quick route to get a hold of me. And then I have two assistants. They're ready to help too. So somebody's going to get back to you as quickly as we possibly can. Follow up, and hopefully, if you're ready at the time, we'll get you down the path to determine the best loan program for you. And if it's a situation that needs a little bit of help to get there, we're along for the ride. We're going to coach you through that. Sometimes, just a kind of a disclaimer, sometimes the credit situation is not just an easy fix like today where it was pay down this credit card. Sometimes it is a little lengthier process, and it does require, there are credit professionals that do that. We have a couple partnerships that we work with that we can refer them to that if it need be. So, but again, my biggest point to all that is you don't know where you are till you find out where you are. So you don't know if your credit score, because Credit Karma says I'm a 620, you don't know what your mortgage score really is. So find out what your mortgage score is. The professional then can give you your score, look at your income, and determine the range of home you are potentially going to be able to afford. And then from that point forward, address any credit issues to get you to that point. Then you determine how committed are you to that road. And what I always say to folks is if you're committed and you're going to work to get a house, I'm going to do everything in my power to help you with your credit to get there and help you obtain that house. If you walk in here today and I tell you your credit score's a 495 and I give you 6 things to do and I never see from you again or hear from you again because you weren't committed to doing those 6 things, then you ultimately didn't want a house.
Right.
So those that want to work, and just like I know how you are too, those that want to work and commit to making that a goal, I will do everything in my power to help them get to that and put together a roadmap to do so.
Sure. And just like Brian said, it all starts with one step. So, if you've got any questions, you've got Brian's contact information. My contact information as always is 502-200-1980. Again, that's 200-1980. You can always reach out to me at todd@ampedrealty.com. But we're always happy to help. We're always happy to get you. And like Brian said, you don't know what you don't know. So don't be afraid to ask the question about what you don't know. So we appreciate your time. Feel free to reach out to either one of us and we'll help you. We'll help you down the path. Brian, hey, I appreciate all your time. Thanks, man.
Yeah.
All right.
Great time.
So
thank you.
Thank you. Appreciate it.
Okay. See you.